Introduction to SRP. SRP is the most comprehensive and trusted source of structured products data and market intelligence. With a global database of 45 million products, our data solutions uncover insights into market structure, sales volumes, key trends, and competitor activity. The choice of leading investment banks, hedge funds, product issuers and distributors, exchanges and asset managers, SRP provides everything you need to understand and stay ahead of the market, with regular updates, data-driven analysis, and access to our special reports covering the latest trends in the structured products industry. SRP data can be accessed from our product search and analysis portal or by integrating our API with your own infrastructure. Welcome to Connected Intelligence.
Hi everyone, welcome to the webinar of America's Market Overview provided by SRP. I'm the reporter with SRP covering the Americas. My name is Summer Wang. I've been covering this market for a year based in London. Before this, I was based in Hong Kong, also with SRP, writing about the APAC markets. So this is actually our first webinar of such kind, which aims to provide a market overview entirely based on SRP data. So today we'll be focusing on the US market with a focus particularly the structured note market, including the status quo, as well as a look back over the past 3 to 5 years. This webinar comes on the heels of our SRP Americas Conference 2024, which was held in New Orleans in just 2 weeks ago. Yeah, so for those who are not familiar with the SRP, we were founded 22 years ago. Currently, we have over 47 million products in our database. So we have 3 main pillars: news, data, and events. SRP used to be known as part of Euromoney Institutional Investor Group until it was bought out by 2 private equity firms and delisted from the London Stock Exchange. Now we have a sister publication, FOW, under the brand name Derivia Intelligence. So in case you wonder, Derivia Intelligence will actually be holding the SRP the Middle East event on 20 November in Dubai. So for this webinar, it's expected to last for 45 minutes with a Q&A session at the end. It will be recorded, and a copy of the PowerPoint will be shared with those who have registered for this event. Without further ado, let me introduce our presenter today, Petar Dimitrov, who is our Director of Data Platforms. Petar has been with us since 2018. He leads a team of analysts to source and validate data from a variety of touchpoints to build the SRP database. And before we get started, you are very welcome to type out any question you may have in the chat box on the right hand. We will get to that after the presentation. Petar, the floor is yours.
Thank you, Summer. Thanks for the very generous introduction. Before we start and before I move on to the first slide, I just wanted to say a couple of, maybe continue the housekeeping bit a bit. What we'll be focusing on is the US market. I'll try to delve into a few interesting high-level trends and also expand on them where applicable to include a bit of extra detail. The data that we have based the visuals on is mostly SEC registered notes together with a bunch of unregistered notes. Now, I'm aware that many of you joining this webinar today are market veterans, so many of these words will mean a lot to you. But if there's anyone who's not very familiar with the US market, just a few quick words. We do have a large number of SEC registered notes that are linked to the governing body, and then beyond that, we're looking at 382 issuance, so notes issued under exemption rules. Also CDs, so certificates of deposit, mostly fully protected products. So this will be forming the bulk of what I'll be talking about. Another thing is, as I go through my slides, I'll do my best to again expand on some of the technical language and some of the terms that many of you will be familiar with, just to make it a bit more user friendly. And also halfway through the presentation, I'll do my best to remind you to post your questions. There will be a prompt at the very end of the presentation as well. The things that I'll cover again in a bit more detail are market size for the US. We'll take a look at dynamics behind underlyings, a few features linked to um, coupons, a lot to talk about also around autocalls. We'll also touch on protection and finish really with protection, hopefully having painted a bit of a wider and brighter picture of the US market. So again, without further ado, looking at the market size at the very start, this is a view of the last 5 years of the outstanding volume in the US. What we mean by outstanding volume here is the entirety of every live product at a given point. You'll see that we have the years plotted here, so at the end of every single year. After a somewhat, I guess, gradual loss of momentum between 2022 and 2023, the market is again on the rise in 2024. With close to 90,000 live products worth close to $300 billion. A lot of the, I guess, of the dynamics driving what we're seeing here in this graph and a few of the other graphs that I'm about to show will be autocallables, and this is a reason why we'll talk at length about those later on. But really, this hopefully shows a market uh, poised to really grow next year as well, and really one of the markets that drive global demand in structured products as well. Another way to think about market size and market dynamics is to try and consider striking volumes and striking, I guess, inflow versus expiring and maturing. This is what we've plotted here. You'll see that, so striking means all the new products hitting the market, expiring and maturing is the totality of what is exiting the market. The net inflow is really the new money staying inside the market. You'll see that the US touched a somewhat high point of close to 30 billion in net inflow in 2022, and that has slowed down since to hover around the 6 billion mark in 2024. The main reason for that in the first half of 2024 is that a large number of autocallables striking in 2023 either matured or more often than not were early redeemed in 2024. So this is one of the reasons why we have this kind of high churn rate in the expiring and maturing. Moving on to rollover speed, what we've tried to do here is really plot the expiring and maturing volume as a percentage of the outstanding at that point in time. So what you're seeing here is that ever since the start of 2023, we tend to experience a somewhat gradual increase at the start of the year, which picks up speed towards the middle of the year, around June, and then is followed by a period of cooling off. One thing that is new in 2024 is that the changes in direction are much sharper, much less gradual. And one way to really think about and try and explain it is, on the one hand, the concentration of autocall products. On the other, the concentration around underlyings and the types of underlyings, how they're likely to really benefit from or be, I guess, affected by things like volatility and the like. So this is all hopefully an interesting slide for some of you who may operate at a very high level of sophistication, trying to make decisions as to put out to market. Just a quick note before I move on to the next slides. May 24, 2024, here is the high point in our graph, and this constitutes a peak of about 17 to 18 billion of expiring or maturing products, just to put things in perspective and show a bit more context behind them. Something that may be on some people's minds after the recent rate cuts is interest products. So what we tend to conceive of interest products is mostly callable fixed rates, callable step-up notes. Recently, there is a bit of an ascent trend where we're seeing a lot of growth interest products, again with a callable feature. Just for context, again, these add up to about 1 billion for 2024, and are in no way a very large blip on the radar when we consider the fact that the entirety of the interest group adds up to slightly less than or around 5 billion per quarter. Something that might be interesting to some of you is that while at the start of 2022, so going back 2 years, we did see that interest issuance tended to constitute about 25 to 30% of what was done in equity. Nowadays, that percentage is much, much lower. After I think a historic low of about 12 or 13% in the second quarter of 2023. It might be interesting to kind of monitor for this trend going forward, and especially ahead of any potential future rate cuts. But for the time being, the issuance numbers are very stable. We've seen that notionals too are quite stable, so something that we felt was worth highlighting here. Underlines then. So we did talk about interest products that don't tend to have an explicit underlying. On the other hand, everything else is very much firmly linked to either an index or stock or different combinations thereof. Many of you will know that the S&P 500 rules supreme in the US, and that has been the case for a long while now. What you see here is single index, multi-index, single stock, multi-stock, etc. Pretty much means all products linked to either a single underlying, that is an index, worst of option, or a basket, that would be multi-index, and then the same for stocks. Something worth mentioning here is that when we look at the single index bar for the first half of 2024, we really pretty much are talking about 2 or 3 benchmark indices, chief among these the S&P 500. Russell 2000 is another one, the Nasdaq 100, or even a Eurostoxx 50. So these are the types of indices that make up the single index category. But again, all of them trumped by the S&P 500 to the extent that we are at a point where we can compare the traded volumes in S&P 500 as a single underlying single index versus the entirety of the multi-index universe. Those recently have tended to almost be on par or to be very comparable. So this really is one way to show the magnitude of how important the S&P 500 is for the structured products market in the US. In terms of single and multi stocks, we do have a bunch of highly preferred stocks. The Magnificent Seven, obviously here. So you've got Apple, you've got Meta, all of the usual suspects. With multi stocks, I guess the landscape tends to vary a bit more. But then it almost always tends to feature one of the very prominent stocks, be that Amazon, be that Tesla, or the others. In terms of the market share that these two hold, tends to be around 60% for the indices, and then around 20% for stocks in the first half of 2024. This has varied a bit in the past 1 or 2 years, with indices going up to almost 70 and 80% in 2022. But nowadays, we're starting to see a bit more action in stocks again. Another look at the underlyings this time, stocks, and how certain sectors have been more, or rather more better represented in structured products. Telecommunications is one of the very I guess, highly active sectors with a four-fold increase, followed by pharma and biotech, social networking, and software and services. Here, really, we're thinking about stocks of the like of Qualcomm, Salesforce, really a very, very wide spectrum of pharma-related stocks. Meta too is one of the big winners as well. But hopefully this paints a bit of a picture around what is trending in terms of stocks. When I say trending and when we see these high percentages, let's try and be cautious, and I want to caveat this by saying that in terms of volumes and in terms of how much of an impact this is making to the market, it is fairly limited just because um, of the really central place that indices occupy. But still, if someone were to try and find interesting and active niches to try and put out to market, then maybe this is something that that is worth considering. In terms of payoff, so when you guys think about, hey, what is my next idea? What is going to be a hit product with investors? One component is obviously underlyings, pricing, another key thing. Payoffs, one of the factors that kind of has a bearing on all this. What we've seen recently is that growth products, and when I say growth products, I'm mostly thinking about participation products, your typical digitals, the twin wins, uncapped or capped participation. These have shown pretty much consistent sales over the past 4 or 5 6 months periods. And the one big difference and really the winner takes it all kind of scenario we see with autocalls, where we started with about 20 billion in sales in the first half of 2022, which is now almost inching up towards the 35 billion mark. So most of the new volume that is hitting the market nowadays tends to be autocalls in one form or another. And to a lesser degree, if you've taken a look at this graph, issuer callables, which again, probably starting from around 6 to 7 billion in the first half of 2022, have increased twofold to about 12, 13 billion in the first half of 2024. Talking about early redemption with issuer callables or auto callables, it's worth mentioning how that really works in big markets like the US and Canada in North America. So what will be immediately apparent to anyone looking at this is that the calendars are quite different. While in the US, we see most of the auto calls featuring monthly or a quarterly calendar, that is almost the other way around in Canada, where monthly and then skipping quarterly semi-annually is the preferred frequency choice. Just a quick comment on what we mean by frequency. This is just the step between two consecutive observation dates for early redemption. So you either redeem your product in January, or then 3 months later, or then 3 months later if you have a quarterly frequency, and similar for the other frequencies. This is one starting point if one were to really think about how fast and how speedy the market is and how quickly money is returned to it, what the kind of the dynamic behind it is, where the concentration is and where the overlap too. One note I want to make here about the US, when we see one time, this is notably missing in Canada. So the one time frequency tends to be what is employed with growth autocalls. So when your autocall product will feature an upside participation at maturity, that often comes wrapped as you get your one chance to redeem early, or then when you wait until maturity, you have this second chance to really benefit from any positive, I guess, movements in your underlying. Something to offset this dynamic that we see in the US, in the case of Canada, for example, is the option to have increases in your underlyings be registered on the level of an early redemption observation date. So what will tend to happen with some of the autocalls is, okay, so do you autocall? Yes. If you are enough above the initial level of the underlying, you may also benefit from some small participation rate. So this is something that we tend not to see in the US just yet, even though there's a very wide variety of kind of structures and flavors of autocalls in that market. In terms of when these early redeemable products tend to release their money back into the market, the past 3 years really, we've seen a very mostly stable status quo where roughly 80%, slightly less than 80%, but a good 80 do auto call on one of the first three auto call dates. Year to date in 2024, that percentage for products auto calling on one of their first observation dates is slightly over 80 again. If we exclude the third date, that is slightly below 80, but still a very healthy number. So it might be interesting to stop here for a second and just appreciate what this really means by performing a very simple exercise. So we've seen that in the US, about 80% of all products tend to have a monthly or quarterly calendar. And now we see that a very stable kind of trend is for all products to auto call on one of the first three dates, or one of the first two. So when we take this together, it almost end up being or meaning that one in every two, roughly one in every two auto calls in the US will tend to be redeemed within 3 months of it being issued. So this is probably one baseline, very simple, somewhat unscientific. I'll agree, but something really to think about. On the flip side of this, with early redemption products that have failed to be redeemed, we have a breakdown that looks a bit like this. I won't go too much into the detail of this, but just a bit of cleanup work. What we're showing is products that have failed to autocall for a given number of autocall observations, be that 1, 2, 3, 4, 5, or more than 5. And then we've broken down that by the type of underlying that is being employed. What I think is very interesting at this stage is to really consider what, and this is slightly negative, granted, but what people might be worried about with these products is, well, how many investors might end up losing money and how much of this will be lost and ultimately not returned to the market in some form. I think that the somewhat risky category here is to the far right with a more than 5, especially where we see single or multi-stock. Multi-stock, probably the one most at risk. We see that about 1.5 billion US dollars is what's at risk here, and then another almost 3 with the single stock. I wouldn't say that single and multi-index products are likely to really breach their barriers, even if they were to be held until maturity, because barriers tend to be sufficiently high for most of these benchmark indices to stay above them, but also something that's probably worth thinking about and considering going forward. In terms of what we can expect in the next really 6 to 9 months going forward, we've done our best to plot how much money will be potentially returned to the market, or as a first step to the investor. Now, in bright colors, you will see growth products being mapped. So this is a subgroup of products that has no potential of being redeemed early. So this is definitely going to happen. This is how much is at stake within that subgroup. We see that in Q4 2024, it's about 30 billion at stake. Many of of those products that we have aggregated here will probably be delivering additional value to their investors. So this amount stands to really increase quite noticeably. Most of it again in index linked products or stock linked products. Then the first and second quarter of next year, the breakdown looks somewhat similar with a slightly lower share of ETFs in the second quarter of 2025. Again, maybe something that is also interesting to plot side by side here is what might also return to the market via early redeemed order calls. And again, we've done this exercise where we try to assume based on current index levels and on the current levels of the most common stocks, what is likely if the situation were to remain the same, what is likely to really alter call. And there is no overlap, just again, to be clear, there is no overlap between what we're showing for Q4 2024 and Q1 2025. So the 33.3 billion, roughly speaking, does not include what is plotted then as 10.4 billion. But again, taken all together, we really are waiting for a good 50 or 60 billion worth of structured products to deliver or fail to deliver to the expectations of their investors. And granted, here coupons will also be quite important, especially in the case of order calls, because this is something that I didn't really touch on explicitly, but most of these order calls will tend to offer a contingent or fixed coupon. So then imagine on top of this, a steady income of coupons over the course of even 1, 2, or 3 months. That ends up adding even more on top of what we've already plotted here. Except coupons, when looked at in isolation from the overall product structure, tend to hover around the kind of the 11 and 12% per annum mark. What we're showing here is how sensitive that has been to changes in the VIX. Now we've taken the position that values higher than 30 tend to really signify very volatile conditions, while values below 20 have tended to signify relatively calm periods. And the interesting thing for me, at least, is to really see how responsive coupon values and amounts have been to the local spikes going back to the start of 2022. There was another quite significant spike in, not mistaken, August this year. So this is also something that has affected coupons going forward. And overall is something that may be interesting to track, especially on the level of underlyings as well. But again, just if there was one soundbite that we could link to this, maybe it is that the US market is not only a speedy one, but one that reacts quickly to all sorts of change. And finally, protection. I mean, people are starting to buy in to this idea of the US market structured products. There is more and more education, more and more effort on the part of, I'm sure, many of you joining the call today. Protection, the way that the investors have access to, I guess, the initial financial commitment has tended to be largely either a knock-in, meaning a barrier observed mostly once at maturity, or different types of buffers, just basic buffers or buffers where you see modified downside participation. Without getting too technical on this, one of the big takeaways would be that we are starting to see more and more deep buffers, so products that offer guaranteed principal protection at levels higher than, let's just say, 30 or even 40%. While not super high number, these are starting to spring up more and more, being done by different issuers. And then something that has remained mostly stable and is somewhat active recently is products with no protection. So this is shown as having accumulated slightly more than 5, maybe going up to about 6 billion in the first half of 2024. And with this, I think that we will end the meaty part of the presentation. I did not spend enough time maybe to talk about key players behind registered versus unregistered nodes. I'll just take a quick second to just highlight something that that people may not be familiar with. So in the 3E2 space, we've been seeing a lot of activity, mostly driven by the likes of BNP, Credit Agricole, BBVA, last but not least, definitely. So a lot of work is being done in that category. So if anyone were to only look at what is being filed with SEC, they may be missing out on some of the interesting trends and some of the work that the people are doing across the board. So just something that I wanted to mention at the end. Another comment on CDs. This is I wouldn't say neglected, but one of the maybe less well-represented groups of products nowadays in the US markets. Although it's probably I don't know, adding up to about 1.5 or 2 billion at least for the year so far. We see a lot of activity from HSBC, Goldman Sachs, JP Morgan, Morgan Stanley, Citi, BMO as well. So maybe these are some of the starting points if you're thinking about CDs. And apologies in advance if I've omitted anyone. This hasn't been intentional. And with this, I'd like to prompt you once again to share any questions in the chat or via the interface that's available to you. And I would like to thank you for your attention.
Thank you very much for the presentation, Petar. So I've seen one question, and while we wait for more questions to come in, I would like you to expand a bit on your observations on autocall. A few of your slides have touched on this feature, which has clearly been the bread and butter. So maybe tell us a bit more about the status quo, as well as any interesting feature you have observed.
Yeah. So anything I say, going back probably 1 or 2 years, will be quite familiar to people working in the market. And if I had to highlight or single out one kind of notable big change is recently, and again, apologies if this is getting a bit too technical, we've been seeing averaging on the final valuation date. So what we'd see is for the final valuation value of your underlying, you'd be taking the average across a bunch of different dates. Nowadays, what's really being done mostly for autocalls is a look back feature, which is the feature that allows an investor really, or the product, to tap into the lowest possible value of the underlying across a predefined period at the start. So this, for example, would do away with any local fluctuations up or down in the underlying, and really make for a more stable and less kind of volatile environment in which investors may want to plan their positions and their investments. So the look back feature, while not, I mean, a big thing currently, is something that is probably on some people's radars. So yeah, that's what I'd really highlight.
Thank you. So one of the questions I've got is about the observation calendar. So the audience asks, why is there no one-time redemption activity in Canada compared with the US? Do you have a thought on that?
Yeah, I'm sure that there is probably someone tuning into this who have a better answer to this question. But I guess that to an extent, maybe the appetite for growth products is somewhat lower, probably, or maybe the sophistication, the viability of those products is probably slightly lower in Canada, or maybe there is less appetite overall for this type of product. Another thing is some people might be buying into the idea that, hey, if I auto call, I may be getting more from my participation. So they may be happy to be locked in for longer periods in those products, or to really, adopt positions that develop in time. I really can't say more in anything more conclusive on this, but really this is a very good question, and probably a very good conversation starter with people who are active in Canada as well. Yeah, thank you for that question.
Sure, yeah. And we got another question about our data. Is the data for REITs products considered complete or robust?
Is the data, because I'm not looking at the question, so could you repeat the question just very
Yeah,
quickly?
is the data for REITs products, interest rates linked
Yeah.
products,
Yeah,
for our
yeah.
database?
Yeah, so is that considered complete? Was that the
Yeah,
question?
how complete is it? How comprehensive?
I would say that within our definition, which I shared earlier at the start of us tracking products that at least have a callable feature, so callable fixed rates, callable step up, callable zero coupon, or just pure callable notes, I'd say that we are covering the full spectrum of data points that you could glean from these. This is something that we've been monitoring because we're quite interested to really know about how those observation calendars are moving, what the coupons are, how those have evolved in time. We have had at least a couple of case studies where people are interested in launching new products in that subcategory that kind of benefits from this type of in-depth research. So really, I'd say we feel quite comfortable with that. And I hope that the trend doesn't go away. It's something interesting and maybe something to keep people active and thinking. But yeah, I'd say quite well covered and very much in depth.
Yeah, like when I write news, I always appreciate our data of the callable fixed rate notes, which has clearly gained traction over the past 2 years. Yeah, and mega tickets. Yeah, that's something definitely interesting.
Yeah.
Yeah, so another question is asking about the breakdown of players you just alluded to, like BNP, Credit Agricole, BBVA. So I guess the viewer is trying to figure out which ones are more active, just in terms of issuer league table.
Yes. I would say that maybe if one was ready to do some work, maybe they would realize that the BBVA are really making a very strong effort to be out there and to put products out to market. This, however, and I would put not second place, because I don't really want to rank uh, players here, but BNP have also been very active. I'll say that maybe Credit Agricole is occupying a bit of a smaller niche currently, but that doesn't mean that they're not active elsewhere. But really, the two big ones, maybe BNP and BBVA, and then this is not caveat, but this is an asterisk here for HG. So the big three, probably BBVA, BNP, HG, say.
Yeah. And we got time for the last question. It's about indices and some feature that we've been discussed, especially in Europe for the
Yeah.
past 2 years, decrement or adjusted return, as well as in Canada. Yeah. So the audience is asking, do you see this feature like in the US structured product space?
Yes, this is an interesting question. Not a lot of that, but one of the indices that I could probably highlight as somewhat interesting in the past couple of months is an S&P defined volatility index. Has a, if I'm not mistaken. So please I mean, go easy on me when I try and cite, but I think it has a 6% decrement. So an S&P defined volatility with a 6% decrement feature embedded in it is something that we've been seeing auto calls linked to recently. Again, not crazy numbers of auto calls, but this is something, and in no way would I say that this is the decrement trend picking up huge momentum in the US. But then sometimes maybe the conditions are just right to employ more exotic underlyings and things that go beyond the confines of what a benchmark index would actually give you access to.
Yeah, and if I may add to that, so just based on my personal observation, like decrement features are gaining traction in the US, but not at comparable level compared with Canada and France, for example, right? Yeah, and we've recently actually done an article about an index collaborated by Mercube and JP Morgan. So that one has got both volatility control as well as decrement features. And it seems like the sales of products linked to that particular index has grown significantly over the past 2 years. Yeah, so if you are interested in knowing more, please do check out our SRP news. Yeah, so I guess that's all the questions from the audience. Petar, is there anything you'd like to add before we wrap it up?
Just a quick thank you to everyone who has tuned in. We appreciate the time. I hope that this has been helpful. I'd like to thank you, Summer, as well, for helping me out with this. This really is one of the first webinars that we've attempted a bit more seriously recently, but we'll be gearing up to offer more. So if anyone is interested, please stay tuned. And again, enjoy the rest of your day, the rest of your week. Thank you.
Yeah, thank you everyone for your time. I hope you find the presentation insightful. On the screen, you'll be able to see our contact details. Please feel free to reach out or share anything interesting you have observed about this market. Yeah, I wish you have enjoyed the rest of your day. Bye.
Yeah, thank you. Bye.